Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Connect, president of Universal Accounting Center, and this is a podcast dedicated to helping you start, build, and operate successful accounting, bookkeeping, and tax services. And as you're doing so, build what I refer to as the premier accounting firm in your area. It's here that you're intended to actually learn the tips, the tricks, the insights that you need to be aware of as you're servicing your clients, offering quality services, and getting paid what you're worth. Every episode is actually jam-packed with ideas, thoughts, suggestions, considerations that you need to be looking at as you're running your business so you can work on those things that matter most so that you can in fact have the company you desire. Now, each week we actually have on the episode experts, individuals that are actually bringing to us insights and perspectives that we need to consider as we're running our businesses and, more importantly, taking care of our clients. And today's going to be a great episode. I'm excited to actually introduce David Podell. He is the president of Business Benefits Consultants, and his team is basically individuals who focus on unique sets of skills and working with owners to extract more of a company's profits than a tax-favored method. So he actually works with his consulting company as partnerships to specialize resources with individuals so that they can actually bring great value to companies of all sizes. Their techniques and knowledge bring relatively unknown strategies to most businesses that they haven't actually been exposed to. Now, David has lectured extensively and actually been sought out as a defined benefits and cash balance plans person. He actually has been featured in Forbes, American Institute of CPAs, CPA Practice Advisors, and multiple small business journals. David has been the acclaimed speaker and educates individuals as to within the accounting industry as to certified strategies. He also has his firm. His firm is commissioned by tax strategists and financial advisors to provide an outsourced solution that allows professionals to implement and manage their plans for their clients. So, David, welcome to the show.
Thanks, Roger.
Yeah, this is going to be a great conversation. First of all, I just want to give a little bit of a backstory to you. What is it that got you into offering tax strategies as it relates to accounting firms servicing their clients?
Financial advisor for many years, did everything in the advisory space. At some point, we had a client that we were working very closely with their CPA, and their CPA had said to me, I think we should look at a defined benefit plan or cash balance for a large deduction for this joint client we have. I got to work on it. I said, I've never done this. I know nothing about it. And we got to work on it and started to try to figure things out and realized that nobody knew what they were talking about, or that I was getting 500 different responses to one question. The entire thing was a puzzle filled with resources, and we got that case, and I said, if we could figure out this puzzle and put it together in a very simplistic way, this stuff is really powerful, huge deductions, and we have a business here if we can make this work and help people understand how beneficial this can be, because there were so many different options, which is usually a good thing, but it makes it very complex and confusing. And we said, let's become the expert here. Let's make this into something that is easy to understand so it can be more utilized.
Yeah, whenever I hear the terms complex and confusing, that's a business in the startup phase, in my opinion, because that's basically an offer that many people are willing to pay for if you can eliminate the confusion and the complexities that are around it. So that's good. Now, the thing that I like about this is, as accounting professionals, one of the things that we try to do or should do is align ourselves as a team of experts to help better service the client, the business owner. And on that team, the people at that table should be individuals that are in that financial space, the legal space, different expertises, if you will, to best service the client's needs. And as we come as accounting professionals, it only makes sense from a money standpoint that finance gets pulled into that. And obviously, tax is a very logical component. So the thing that I'd like to start with is the difference between what's tax preparation versus tax planning.
Yeah, so for us, the referrals and the business that we get and what comes in, they are generally coming from accounting professionals that are dabbling into tax planning or want to be more involved in tax planning. This solution is one of the oldest and best ways to add value to a client, be fully involved, where you're not just talking to somebody once a year, where now you actually have to talk to them multiple times a year, and can charge for a value because clients are consistently coming to you and saying, help me, help me. I don't want to keep paying. What else do you have? Well, here is a huge value add that can be brought to the table. And if you have the right resources and you know where to go and how to do it, this is tax planning.
Yeah. Now, one of the things that I find interesting is there's different strategies when it's business versus personal tax strategies. Where do you find the biggest advantages as it relates to planning when working with that business owner?
So these are business owners or solopreneurs or entrepreneurs. These are generally going to be people that what I would call control their income and can control their time. It doesn't matter the structure of their business, but if they have that ability, they're not just straight W-2 employees that work for a company. These are businesses or those that are getting side income that have additional income and they want to pay less in taxes. So and we do a lot of plans that are solo, that are individuals that don't have employees. And this becomes even more beneficial to do for them. But from the level of having employees versus not, there's many different ways to go about doing it.
All right, so let's start with a few things that might be of interest. So, as an accounting professional, you go into a business, and it just so happens to be that the individual who owns it is a W-2 employee. So clearly, they're in that position where they're being taxed at the business level, they're being taxed at the individual level. What are some good strategies to help that person that's a W-2 individual that they may not be considering?
Yeah, if they're getting if they have an S-Corp, for example, and they're getting a W-2 from their own business, that's generally what we see. And the idea there is for them to be able to pull as much money out of that business that they would like to put away into a large deductible retirement plan, such as a cash balance defined benefit, and reduce their tax liability and keep the most of that benefit. So when there's employees, these plans have to cover employees, but the scale shifts the way the designs work. And one of the things that I want to get through to your audience that I'm out there preaching all the time is that generally someone will say, oh, you have to go to a third-party administrator or an actuary. What we found out a long time ago and why we started really getting into this is every design is different from the next. So you can go to that actuary or TPA and you will get something back, and maybe you're giving a portion to your employees that you're not happy with. You can go to another design and maybe that portion, the bulk of it is really going to you and very little is going to the employees. These are owner enhanced benefit plans is what I call them. They are there to enhance the owner. They are not employee benefit plans like our on the shelf type plans that we're used to talking about and hearing, such as 401k, simple set plans. These are structured primarily for the owner. So while employees are getting covered, there are ways to shift that scale and make the largest portion of that benefit to go to the owner. That's the point.
All right. So before we go too much deeper into the strategies of these things, I do want to ask from an accounting point of view, there's a relationship between what you're offering and what the accountant is doing on a day-to-day basis within the company. So I'm curious, how does the accountant introduce this type of a strategy as it relates to tax planning? But more importantly, how does the accountant get involved? Are they involved on a quarterly basis, a semi-annual basis, an annual basis? And is there a way for them to financially, as a service, benefit from this approach of working with the client?
Yeah, so working backwards from those questions,
Okay.
100%, we want the accountant to benefit financially, and yes, they can, and there are many ways that they should, because they are fully involved in these plans once this happens. They have the ability to move that W-2 around based on how that plan works. They have the ability to do certain things with the income, and certain things are required every year for compliance testing and all that stuff. And they have to be involved in that. and that is work. So to your other questions, to tie that in, you're essentially looking for the client that's saying, I'm paying too much in taxes. What else can we do?
Mm-hmm.
Or I've pushed revenue into the next year because I don't want to pay taxes on it. Or I'm going to buy additional equipment or another car or something else that I don't need just so I can reduce my tax liability. Those are all great prospects for anyone to be putting money into these types of plans, because here's a simplistic way. Well, we make it simplistic to take that income, put it away for the owner directly, and get it out of the business instead of putting it into something else or trying to do all those other things just to move money around that they might not need to do.
Yeah. So you brought up a number of things there that I do want to jump into. So from a business point of view, yeah, those strategies of we're going to defer revenue, we're going to purchase more equipment, we're going to buy more inventory. I mean, there's different things that you can do to kind of change what that year tax number is that you're going to then be calculating your tax return on. But the problem is then I'm causing my business to not look as profitable as it perhaps may. Therefore, I'm affecting the valuation of my business, but saving tax dollars. So there is a give and a take. Am I wanting my business to have a great valuation, and am I looking towards an exit strategy, or am I at this point just doing tax mitigation and trying to actually minimize the tax liabilities I have simply because I'm exploring some of these strategies at the business level? Is there anything you would add at that business level so far?
Yeah, so to speak on valuations, these plans essentially help increase the value of a business. And we've been through a lot of sales and buyouts and mergers. And when a business is getting valued, and if an owner is putting away, let's call it $200,000 into a defined benefit plan, and they're getting 90% of that benefit to the owner, it becomes an add back that comes in to help the valuation of the business, because it shows that if the owner wasn't doing that, they'd be able to actually pull more income out of the business than they are. So it's on the benefit side of a valuation rather than being something negative. So it does not hurt that business. It's actually helping.
Very good point, because it's an add back. All right. So at a personal level, you've got the different strategies that a business owner can be doing. From a W-2 point of view, it's fully fund your HSA, it's fully fund your 401k. I mean, there's different things that clearly rise to the top of here are clearly things that you can be doing that minimize your tax liability. But you're suggesting that there are these additional type of strategies that they can be using. Give me a few, let's say the top three that you found are effective at the W-2 level.
When we talk about W2, are we talking about a business owner? Or are we talking about somebody
the business owner?
Right.
So here I am.
So,
I'm taking obviously a sizable income simply because I've got to show to the IRS I'm being paid fairly. So I'm getting paid, but at the end of the day, I'm being taxed at the company level. I'm being taxed at the individual level. I'm implementing strategies at the business level to mitigate my taxes there, but I want to mitigate my taxes at the W-2 level. So there are different things that I should or can be doing there. Obviously, as an accounting professional, I'm wanting to give that tax advisory and help them in the planning of the year of things that they can be doing. So I'm going to say fully fund your HSA, fully fund your 401k. What is that list of things that you would suggest from a W-2 point of view they should be considering?
Yeah. So on the W-2 side, the most common that we're going to see, and in relation to this, is going to be the 401k, right? That's going to be the biggest deduction off of the 401k. Everybody wants it to, every business owner wants to take the smallest W-2 that they possibly can. The smaller W-2 actually is going to allow less money into a pension plan. So we try to relate with what does somebody want to put away in that plan to where should that W-2 be, with the accounting professional saying, here's reasonable compensation and here's where you can do this. So that W-2, sometimes based on what someone wants to put in a plan, we might say this is going to have to go up a certain level to get as much as you want in there, or this is where it was, this is where it is, let's work with it and tell you the max that we can get in there and then tweak the design around that. So there's a lot to play with there. But to your question on what else can you do from just the W-2 standpoint, and we don't see someone trying to get the largest possible deduction on W-2. It's usually max that 401k, and maybe you're doing HSA or something else, but it's really on the business profits. That's where we're trying to bring numbers down. You have the revenue and then those profits, and those profits that are taxable. We're trying to bring that number down so you can often trigger all different types of other benefits when you're bringing that income down, often putting you in a lower tax bracket because you reduce that income down by that money now going into a retirement plan, which is growing, which you're going to have in the future. From a diversification standpoint, you're also pulling money out of the business and putting money away for yourself and growing a net worth individually.
Okay. So before we move back to the business, one last question. So if I'm minimizing the W-2 earnings in the effort to actually minimize the taxes there, how are you suggesting that the business owner be paid or compensated other than the W-2? Is it simply through the dividends? They're being paid out that way. I mean, are there other things that they should be considering in order to actually have the take-home income that they're looking for?
Yeah, it's trying to balance a whole bunch of things out on the company profits. You have your W-2, which you're earning from, and that's usually not enough. And then you have profits and dollars that you're pulling out of the company,
Okay.
keeping enough money in the company for cash flow and everything else that you need it for, and expenses, and then taxes, because there's still taxes, right? We have had many situations where an accounting professional says, I want to bring their taxes down close to zero. What's the max that we can do? And we'll design around there. And they're able to do it, and they can bring that all the way down. But generally, there's still some kind of taxes that are getting paid. The other great thing about these plans are if you're making estimated payments, you could cut those estimates in half, take that half that you were sending to the IRS, and now use that to put in the retirement plan.
Oh, interesting.
So you can really, move money around in ways that's going to trigger some very good benefits there.
All right. So with regards to these, I'm wondering, let's just kind of recap what the plan is, what the strategy is that you're trying to do here, because I don't think it's fully clear to my audience, at least it isn't for myself, what we're trying to take advantage of. So let's kind of put it into that business context of, I've got a business, I'm the owner, I'm obviously interested in taking advantage of some tax strategies. What is it that you're suggesting they consider employing, and how is it beneficial to them?
Okay. So essentially, you want to look at this as a 401k with a much, much, much larger limit than you're able to put away. So
the minimums on a 401k, I think, are like 30,000. Isn't that right?
Yeah.
Yeah.
Right. So here we have plans where people are putting away $800,000, $1 million. I would say on average, you see plans around the 150 to 250 number. I'm always asked who's a good prospect for this, and I'm going to say anyone that can put away, any business owner that has the ability to put away $100,000. Okay. You really don't want to be under that number, because then you can go into the traditional retirement plans.
So I'm assuming they have to be an accredited investor at that point.
They don't have to be an accredited investor, because we're not talking about actually investing. We're talking about a tax strategy. I'm going to put this in the tax strategy and design space before I'm going to go and put it on the investments and and areas of growth and all that. That's a secondary conversation and part of this. The first part is, what can we put away? What does that design look like? How much do we have to give to employees? Because ideally, we're trying to get the owner around 90% or higher. Sometimes that's going to not look good, and sometimes that might be in the 70s, and sometimes that's in the 80s. And do we want to give that kind of money away? It really just depends. But we're looking at multiple designs. We work with all different actuaries. We don't look at one. And then we try to find and tweak the best possible design for what that client's trying to do. Another thing too, just because I know this will come up, we only look at designs and we only put together plans that are very flexible. We understand that a business owner might have $100,000 to put away 1 year, but zero the next, or $300,000 the year after. Like, nobody wants to be stuck with, this is what I have to put away every single year, and this is all, and I have to have this. It just would never get done. The cash flow is just not there, and there's uncertainty in all businesses, especially look at our economic and stock market situation right now. There's uncertainties. Nobody knows what they're going to earn next year. So we add a lot of flexibility into these, so they know that they have big ranges, and we're very involved with how the business is doing throughout the year, every year. And that's also where the tax professional, the accounting professional gets involved, because we need that kind of planning throughout the year to make adjustments to these plans to adhere for what is it going to look like by the time we need to fund.
Well, you've actually addressed two things that I'd like to dive deeper into. One is cash flow. Clearly, it's the ability to fund the accounts. And so once you're setting them up, the fact that you're able to say that they're flexible is very appealing. But the thing that I'd like to understand is this a month-to-month decision, a payroll-to-payroll decision, an end-of-the-year decision? Is this something that can be done after the end of the year, before the taxes are filed? What kind of constraints do you have from a cash flow perspective as to when these are needing to be decided?
It could be all the above. That's the
Okay.
good thing. But right now, for example, you can fund up until tax filing, up until if you have extended out, you can still set up these plans and still take deductions from last year as a last year's plan. So you can continue you can do this up until your filing. If it's going to be in April, then plans has to be set up now. If you're on extension, then you have all the way up until that time, or around the summer,
Okay.
to get these plans set up and to fund at that time. Now,
So I could be funding in July or August of this year for last year's tax return that I've yet to file.
yes.
Interesting. So
Yep.
regarding the funds, are they liquid in the sense that once they're in, I can still get them out, or once they're invested, are they locked up for a period of time?
So just like any retirement plan, once they're in, they are in for retirement.
So there's penalties for taking it out earlier, or it's just not even accessible?
That's correct.
Okay.
We're going to say that we will always tell someone, these plans, if you're going to go down this route, you don't have to fund at the same level every year, but you want to keep this plan open for around 3 to 5 years. They're meant to keep open for around 3 to 5 years. Now, when that plan is closed, it can go to an IRA, and then it's just like any other IRA. You can continue to defer till to retirement age and do whatever you want with it. But while you're putting money in these types of pension plans, you really don't want to touch it. You do want to have the intention of putting money in for that time frame. Now, if you sold your business, if you retired, if you had a medical issue, yes, the plan could be closed, no problem. But you just want to go into it with that intention of a 3 to 5 year, at least putting money in there.
I'm curious why the 3 to 5 years and not longer.
The IRS, Department of Labor, are more concerned with benefits being taken away from employees than anything else. So, from a audit standpoint and how these things are structured, it is a recommended time frame to have these plans open for that time frame. You could freeze these plans too, so you can maybe put in money once and then not do it again, and you're just frozen, and it's still growing and accruing. The investments are still growing in there without you having to make contributions, but you still want to keep it open for that time frame.
All right.
Less audit risk.
And you've brought up employees a few times, and you indicated that for the business owner, they're able to get the majority of the benefit of this because of the funds being in their name, but you've given percentages from 70 to 90+%. I'm curious, so what's the employee getting out of this? Is this similar to a 401k or a profit sharing type of opportunity where as an employee, I'm benefiting as I'm seeing these funds put in there? Is there a vesting period of time that's associated with it for the employee as well?
Yeah. So the employees are getting a benefit in there. The employees are not putting their own money in there. When we talk about these plans as combination plans, it's going to include cash balance. It's going to include a profit sharing component, and it's going to include 401k. And somebody might have, generally, we see a lot, there's a 401k already in place, and we try to work around how that document is set up already. We don't want to disrupt it, change it, or do anything with it. Profit sharing is often there to help offset and take care of what needs to go away for the employees. Now, the funding that's going in there is from the company. So if you're putting into the profit sharing component $50,000, that is company money. And that's going to have a vesting schedule on it. So if an employee leaves and they were eligible to get $1,000 out of that, and they left before they were vested, they might get zero. They might get a very small percentage that they can take, but it's not their funds. So they're generally not getting a direct statement that says, hey, here's what the company put away for you. That statement is coming from an actuary, and then the employer is distributing that.
And do individuals need to be W-2s to participate, or as a shareholder, are you able to actually have this as just something that you're using to defer some of those tax liabilities that you have?
Yeah, that's a good question. So if an employee is W-2, then yes, they're on there. They're gonna, they're included. If they're 1099, they're not. If they're part-time, we need to list them, but they're not getting an allocation. They're not getting anything.
But a shareholder doesn't qualify as well?
So if they're a shareholder, then you have options. If it's a shareholder, depending on the amounts and everything, they could, or another. Let me give you an example of a case where we have that we've done before. Let's take a medical office where you have a doctor that might be older and really wants to max out retirement and put in as much as possible. And then you have a partner doctor who is younger with student loans, young kids, saving for college, and wants to put in very little or nothing. You can do that. You have, as shareholders, you have the ability to change that around, and one can put in. We've had this $400,000, and another one can put in 50,000 or 10,000.
But when you're saying they put in, I thought the company was putting it in. So
the
it's
company
irrelevant.
Yes, the company is.
So why
would
the individual who's the younger want less money put in their name when they're the shareholder and the company made, let's say, 400,000, and they want to put in 400,000? Wouldn't I want my money? Wouldn't I want that company money in my name?
Yes, they're getting, the younger shareholder is basically saying, because what you're doing is you're adjusting the K1 for the partnership,
Okay.
right? So that younger partner says, I need this money. I don't want to go and put away a few $100,000. I need it in my pocket. So their K1 is going to reflect differently based on what went in the plan versus the older one.
Okay. So as I'm talking about this, one of the things that I'm not clear on is, what's the name of this strategy? What is this called?
Defined benefit plans.
Defined benefit plans. And as
Or
a defined benefit
or
plan,
pension, right?
And the accountant, their role in this is exactly what?
Their role is to coordinate with people like us, so we can bring all the resources together, whether TPA, actuary, us on the consulting side, them, advisor, all those things need to be involved and coordinated. And we're that one place where we can say, okay, you only have to talk to us, and we're going to go in and bring everybody to the table and make sure everything just works and is accounted for. And we're having these conversations consistently with them to make sure that the plans are successful.
And as an accounting professional, is there a way of defining or determining which of my clients would be great candidates for a strategy like this, in the sense of what things should I be considering before I even introduce the idea?
Can they put away $100,000 or more? Because if they can't, then there's plenty of other retirement plans that they could be doing that are beneficial
For the business.
For the business. Yep.
And so for the business, if the business does not have liquid cash of 100,000 that they could allocate to this to defer the tax liability for that given year, you're saying that they wouldn't be able to take advantage of this, even though in the next year they could pay less than 100,000.
It's not beneficial enough to do it, to use this. There's other things that are more simplistic that can be used that don't need these resources or these costs.
Okay.
Right. So you're better off going with some kind of 401k or simple type plan. And look, there's negatives to those. There's not as many benefits that are there, but they outweigh what someone would be getting for if they weren't able to put that kind of money away into that plan. Another profile is going to be, are they paying a lot in taxes? Have they done other things for tax mitigation? What have they done? If they've done restructuring or any other strategies. This is one of those things, though, that doesn't push the line, and there's no gray area in the tax code of an issue. This is not something that's one of these online, take a look at this and go through that, and you might have, audit problems, and it might or might not be legal. This has been around forever. This is pension planning. This is retirement plans. It just falls on the tax strategy side because of the huge power of that deduction that you can get from it.
And for the business, is there a certain structure that can take advantage of this? Is there all types, corporations, S-Corp, C-Corp?
All types.
All right.
All types.
And so you made a comment a moment ago, and I just wanted to clarify. So if the business does not have the $100,000 liquid that they can take advantage of this pension plan, why is the 401k the option? Because I thought the 401k isn't benefiting the company.
So the 401 is an option because they're getting a deduction on their W2, but there's always a profit sharing component in that 401 that they can take advantage of.
Now, so you're talking about the employer contribution portion of it,
right? Because a 401k has both documents in there. It's the it's the 401 and profit sharing. The difference is that calculation for profit sharing changes when you add defined benefit as a separate bucket there. When you have a straight 401, most people do not use the profit sharing component of a 401. And the reason is because when they get the calculation, they realize they're giving more to employees than they're getting as an owner. Once you go and you add a different design to it, whether it's cash balance, defined benefit, or one of the 10 different designs that we work with, you're going to see that scale start to shift toward the owner, where now the owner's getting 80, 90, 95% of that benefit.
Which is above and beyond the 401k that they're also contributing to through their W2.
Correct.
Yeah, interesting. Now, I'm curious with regards to this, obviously there's risk with all of these. What's the risk with this one? With this strategy?
So the risk really becomes where if somebody puts money in and then they say, yeah, we can never put money in again, right? That's kind of where you don't want to. It doesn't become a huge problem. It becomes something that needs to get rectified, or take a look at all the different options that are out there within the design. Do you freeze and have to wait before you shut it down? There's so many different things that could happen. The other risk is you could possibly have a census or a demographic of your business where it just doesn't make enough sense, where the owner's not getting enough of that benefit. I brought up, if it's 75, 80% that's going to the owner, you might say, I'd rather pay the taxes and not give my employees that kind of allocation. I was really looking for 90 to 100% to myself.
Yeah.
Like I said, we do a lot of solo plans, which are great because there are no employees, or you have a lot of clients that are maybe W2 or have a job somewhere, but then they have a side business, or they're getting consulting income, or they're getting 1099s by doing other work. And those can be used to be pensionable.
Interesting. How would this differ from something like a Keyman insurance policy?
So Keyman, you're essentially insuring should something happen to an owner. That's a non-deductible expense. That is more of a protection piece. This is pulling money out of the business on a pre-tax basis for the owner. That's essentially what you're trying to do.
So even when the premium is being paid by the company, you're saying that that's not similar to what this is, where this is being funded before taxes are calculated.
Yeah, I mean, Keyman is not doesn't fall into the realm of some kind of benefit for an owner. It's more a benefit to the company should something happen to somebody, and it's more of a protection piece. Even if you go down that realm and you talk about like non-qualified deferred comp,
Mm-hmm.
like there's not a deduction that's there immediately. So you don't see deferred comp happening on owners for them to put money away because the money's not getting reduced initially by going into this box. Here we're creating a box. Whatever you put in that box is helping you pay a lot less in taxes.
Interesting. Now, what type of income qualifies for this? Because earlier I said being a qualified investor, what type of income qualifies for this?
So we generally see a company that has profits of 250 and up.
Okay.
That's putting that kind of, so that's where you get to that 100,000 going in. We've obviously done this really on very big scales where there's millions and millions of profits that's there.
Mm-hmm.
And you could, even if you're saving, your savings when you're doing this they're generally in the six-figure number. So it is a big tax savings, but it depends also, do you have the ability and cash flow to put away that dollar amount?
So what would be the advantage of doing this versus paying out the dividends? Obviously there's the taxes, but
It's taxes. That's it.
okay.
A lot of times you're going to get someone that says, I'd rather just, I like to do these things. They say, I like to do certain investments and things on their own, or they like to do other things and just have that cash, and they'll just pay the taxes and they will not want to put money away, and lock it up to retirement. And or they want to go and take those funds after tax and they want to invest that way. This is, we'll always say in that situation, though, just don't take all of it, but do something, right?
Interesting. Yeah.
Do something here, like pay less in taxes, use this benefit, and then also have the ability to do those other things.
Very good. Well, one of the things I quite like is I oftentimes have on the show different tax experts as it relates to tax advisory or planning strategies. And so, where so many of my listeners happen to be tax preparers and are in that tax planning space, it's nice to be able to actually go to the client and actually say, here are some strategies that we can actually implement this year that may help mitigate some of your tax liabilities. So, just having this discussion today to share some of these insights is very, very helpful. Understanding also that the accounting professional can collaborate with you and have you as part of the team as it's implementing this strategy from a financial point of view is, I think, very important. So is there a last thought as to, as an accounting professional, what is the telltale that this is something that I should be bringing up with my clients? I mean, you talked earlier about the triggers of I don't want to pay taxes, or I, went and bought a truck, let's say. But is there anything else that I should be considering as an accounting professional that we may not have addressed already?
Yeah, these plans would definitely work better with a smaller demographic. So we generally see plans under 50 employees. If there's 100, 200, 500 employees, a lot of times that doesn't work. I can tell you we've done a bunch of those plans where it does work, but you're generally going to see these on the smaller employee scale. I would say the average that we'll see is 1 to 15, 1 to 20 employees or so.
Okay.
But in the smaller scale, that's really where you're going to see somebody look to put these away. We work solely with we don't do any marketing. We don't really get any referrals directly from a specific business owner. It's gonna our business that comes from all different tax professionals that want to go and add a value to those clients. They want to move more toward that tax planning realm. They want to have something that they can have more conversations with and show that they brought an out of the box strategy to them that is very different from, let's just go prepare our taxes and here's what you owe, or let's prepare your estimates and increase them because you did better this year. Like, that's, industry is obviously moving away from that, and everyone's looking for something that they can use from a planning standpoint. This is a great way that they can charge, you could get paid for, and they can consult and really, add a huge benefit to the client. And they're getting more referrals because of it, because someone's saying, oh, I do this plan, and my accountant connected me here with this plan, and I saved X amount of dollars this year because of it. We don't do any calculations on the tax savings. We can give some approximate estimates based on a percentage that we'll often put on proposals of how much it would save in taxes based on just some kind of percentage. But the true benefit in tax planning is, come to us, you get some kind of number on what they can do. We go through everything that we need as far as an intake form. We come up with a design, we come up with a good benefit. And then as a tax professional, you're able to say, hey, here's what you currently owe. Here's what you have. Here's what you paid last year. If we deploy and implement this strategy, here's what you're going to owe after the fact. And that's planning. That's showing that you added something of value in there that they can take away from.
Yeah. Well, one of the things I'd like to do is wrap this up. But before I do so, I want to point out that for my listeners, Dave has been very kind to actually say that if you'd like to be that accounting hero, that individual that goes to your clients and offers them some tax saving strategies, you can take advantage of the opportunity to actually speak with David and his team, and more importantly, get some insights as to how this might be applicable to the clients that you're currently serving. So I want to invite my listeners to go to the episode description and find out how you can actually reach out to David and his team, booking a call to learn more about this and other strategies that you might be able to collaborate with and actually implement for your accounting clients. So take advantage of this opportunity. Go to the episode description and get that information there. In addition, as sponsors of Universal Accounting of the podcast, we want to actually encourage you to get a copy of the book, Your Profit and Growth Expert. It's here we also talk about additional strategies that you can be considering as the business advisor to your clients, helping them utilize various strategies to, in fact, work on their business, and more importantly, see you as the CFO advisor that you, in fact, are and should be. In addition, if you'd like to dive more into tax planning and tax strategies, I encourage you to become also a tax professional, a certified professional tax preparer. It's here that with Universal Accounting Center, you can get the skills, the training, and certification to show that you're proficient in both the individual and business tax preparations that you can offer as an accounting firm. So take the time to go to the episode description to find out what you and your staff can do to become certified professional tax preparers. Now, as a recap of the show, I want to actually point out I've enjoyed the conversation because I do believe that as accounting professionals, we need to be considering ways that we can be that messenger, that hero to our clients, to share with them different strategies and approaches that they can be considering to ultimately keep the monies that they're earning. They're making the money, they're entitled to keep the money. And so if there's legally ways that we can tax mitigate their various revenue strategies, I think this is something we ought to consider. So as a summary of our conversation, here's one of the things that I'd like to do is, first of all, thank David for coming on and introducing us to this. I think one of the things that I was excited to learn is just how it's actually used, because clearly you've got situations where you've got the company trying to mitigate its tax liabilities. You've got the individual, especially the W2 individual, that's trying to say, what approaches can I use? And this is something new to consider. And from a profit sharing point of view, it's always nice to see how can we actually keep more of what we're making. And this is perhaps a way to actually leverage that and minimize some of the tax liabilities. The other thing that I thought was helpful as part of our conversation is just understanding that there are different things that as tax advisors we can be doing to have a seat at the table with a CFP or perhaps with a lawyer or possibly other individuals to best service our clients. And if we actually have this seat at the table, we can fulfill our role in basically introducing them to these other key individuals that the business owners should use and should leverage as they're trying to build their companies. The other thing that I thought was very important is just to understand what were some of of the qualifying characteristics to actually implement this, to have the $100,000 or more in cash that we can actually use to deploy this, that it actually would be a plan that would be for about 3 to 5 years. And then most importantly, that it was for firms or companies rather that are fewer than 50 employees. That right there is a great way of indicating whether or not the people you're currently working with today would be great candidates for a strategy like this to defer their tax liabilities. So all that being said, I thought this was a wonderful conversation, at least if nothing else, to just kind of broach the topic of what can we be better doing to service our clients and keeping the monies that they have earned and made. So David, what would you leave as a parting thought?
Take a look at these. For any clients that are complaining about their taxes, now is such a great time, right? Having conversations about preparation. Also, taking a look at, from a cash flow standpoint, we talked a bit about when you have to come up with funds or have those funds. If we're past last year, and if we're not talking about last year and we want to plan for this year, you have between now and next year's extension to fund and put away cash flow for this. So it doesn't become something that you have to come up with that money in the next few months. You have over a year to do it. So it's a great time to have that conversation now and really look at this as a tool.
Very good. Well, David, I appreciate you taking the time to share with us these little insights. And I thought this was, a great conversation to have, especially this time of year. So thank you for your time. As for my listeners, if you haven't already subscribed to the podcast, I'd like to invite you to do so. It's here each and every week. We have on experts to share with us various things that we ought to consider as we're running our business and servicing our clients. So I invite you to join us by subscribing and setting your notifications for each and every week when we have a new episode released. In addition to this, I'd like to encourage you to go to universalaccounting.com. It's there online that we've actually put together playlists, essentially the highlights of various episodes that we've had over the years. These are packaged or prepared in playlists based on topic ranging from marketing, selling, pricing, client onboarding, client retention, mental health, just a variety of topics that I'm sure are more relevant to your current situation that you can go now and binge listen. And I encourage you to take advantage of that and do so accordingly. In addition, on the website there at Universal Accounting, there are also free resources, things that you can take advantage of today that are actually designed to help you work on your business. There's things to assist you from books and white papers to courses and programs. Take advantage of these free resources to see what it is you can be doing to work on your business today. In addition, I also want to encourage you again to become a professional tax preparer. Go to universalaccountingschool.com to learn more what it is you can train your staff to offer quality accounting services as professional tax preparers, professional bookkeepers, QuickBooks specialists, as well as profit and growth experts. Each of these programs are designed to enable you to offer the quality services you can and should as the premier accounting service in your area. Lastly, I'd like to point out GrowCon. GrowCon is a conference for owners of bookkeeping, accounting, and tax businesses. This is a must-attend event for owners of accounting firms. Why? Because it's here that you get to meet your peers, find out what it is they're doing to actually build their businesses, collaborate with them, build friendships, hear from the experts at the stage where they actually share with us the various things that we need to be doing on our business today. And then lastly, meet my staff, those here at Universal Accounting Center who are committed to helping you be in business for yourself, but not by yourself with Universal Accounting. So I look forward to seeing you there. Go to universalaccounting.com. In the navigation, find out the information regarding GrowCon, register, and I look forward to seeing you at the next conference. All that being said, always remember this: accounting success is universal. Take care, be safe out there, and have a great day. David, that was wonderful. Thank you.
Thank you.
I enjoyed the conversation. It was insightful. Here's what I'm going to have you do. Go to the side there where it actually has the script, and I'm going to have you now record that promo piece.
The script, where is...
It's in the chat.
Okay. Start now, or?
Yep, whenever you're ready.
Okay. This is David Podell. It was great to record with Roger an episode of Building the Premier Accounting Firm. We discussed defined benefit plans as a tax strategy. I invite you to listen and join us.
Perfect. Thank you, David.